Edgar, we are jumping to you now. Are you there?
Hey, morning, guys. How you doing?
Doing
Pretty good, Edgar.
doing
How you
good.
doing?
How's it going?
Good, good. Y'all's lines are blowing up. It finally got through to get to my question.
I know. Trust me. We've been seeing it on this side. It is nonstop.
The board is just lit up like
crazy.
crazy.
Is lit up all over the place.
Well,
Awesome. I was just telling my wife y'all my Saturday morning coffee. As soon as the music comes on, time to wake up.
yeah. Well, Edgar, we appreciate you tuning into the show, and we appreciate you fighting to get in for the call.
Yes, sir. A couple of questions. One for each of you. The first one is, I don't know if they've already asked this one. How does, this one goes for Chris, how does an FHA loan benefit me as opposed to a conventional loan or vice versa? What are the benefits of both?
Yeah, that's a good question. You know, they're both great loans. And the way normally you identify the difference between an FHA loan and a conventional loan has to do one of a couple of factors. Number one is an FHA loan is 3.5% down is your minimum down payment. And you can also go down to credit scores all the way down to a 620 very easily, okay? It's capped out this year at 295, 550, which is the maximum loan amount. So if you're looking at buying a home, let's say for less than $300,000, you've got minimal money down, let's say 3.5%, and you're going to go ahead and your credit, let's say, is less than a 660 or even a 680, you'd probably want to consider an FHA loan. And here's the reason why. An FHA loan has absolutely no hits in interest rate, depending on what your credit score is. And even though it does have higher mortgage insurance at those lower levels, it's going to probably be equal to the conventional market. Now, where the conventional market's really strong is if you're buying a home and you're putting 20% down or 10% down, you have very strong credit, let's say a 720 or plus, your mortgage insurance is going to be cheaper. And if you're buying a home above $300,000 but less than 417, then your conventional market's going to be a very good market for you right there. So they're both really good products, and they both fit their respective markets really well. It really comes down to a couple of those factors: credit score, down payment, and then the price of the home. And then, again, those are going to be sort of determining factors. What we always like to try to do is run the scenarios. Run a scenario and say, okay, based on what you're looking for, here's what that scenario would look like. Now, one of the things we tell everybody, always buy a home based on what your budget is, not on based on necessarily what you qualify for. And I mean that in a good way. If you qualify for $400,000, but you only want to make a $1,000 monthly payment, then don't go out and look for a $400,000 home because you're never going to make it in that range.
Right.
You know, those are some of the things that we look for right there.
Gotcha. So it's just basically something that is adjusted according to your goals, the budget that you have. That's what each product depends on. At least that's what I'm understanding.
That is correct. That is absolutely the way. It's 100% dependent upon what you're looking for, what your goals are, what your budget is, where the home is, and then more importantly, what you qualify for. Because, you know, the other thing is debt-to-income ratio. On a government loan, I can go up to 50% debt-to-income ratio. On a conventional loan, I got to stay less than 43. So you have to also measure some of those things.
I see. Got it. Thanks.